What's up, guys? Michael.kee, investment advisor with EKC Financial Solutions. Uh, if you notice, I have a pretty different setup tonight than I have in my last videos, and the reason being is I'm still trying to, find the look I want and how I want this channel to kind of conduct itself. And I think I'm getting closer and closer, but I've never been one that's been great at the technology stuff and the video editing. So I am getting better, and I think you're going to see these videos kind of grow with me along this channel. So I hope that each one just keeps getting better and better and better. But today I want to talk about, things that I see on the internet, particularly one post I saw last week. I was actually going to do a video on and started putting that together, but couldn't really get it right. So I think I'm going to hit on it tonight. And we all know who Dave Ramsey is. Dave Ramsey is a huge figure in the financial world. And Dave Ramsey has helped a lot of people and has a great message to share with people. I do think that there is a difference in someone who's in my role as a financial advisor than someone who's in Dave Ramsey's role. A lot of that has to do with regulation, just to start, right? I have my securities licenses. I don't believe Dave does, because he wouldn't be able to say a lot of the stuff that he says. But I'm not too familiar. Again, I'm just starting this out, so I'm not too familiar as far as what those guidelines are. But I don't think Dave has or ever has had his security license, which isn't discounting him at all. In fact, it gives him more freedom, I would say, to help people and get a message out there, because there's a lot of things that I would be limited to talking about. But the other fundamental difference would be he has a message that goes kind of to the general public, and I myself, I work with people on a case-by-case basis, so everyone is different. And I brought this up in my first video. Everyone's different. Everyone has a different situation. So by the time they have come to me, then we're looking at specific, circumstances and how I provide recommendations to them. And I say that to say this. Dave had put a post up, let me pull it up here, last week on his Facebook, and that post was, that just talking about the things that he tells people not to do and what not to invest in. And his list that you should invest in included mutual funds, and he has his 4 different kinds of mutual funds: growth and income, aggressive growth, and international. And then he said real estate if it's paid for in full, that's fine. But where my issue kind of lies with this is on the bottom end of his list, on the don't invest in side. He has single stocks, Bitcoin, whole life insurance, annuities, bonds, micro investing, REITs, ETFs, and CDs. And my problem with that, first of all, just to start, the first contradiction on this is, and I've listened to Dave talk on his channel about ETFs and mutual funds. ETFs and mutual funds are extremely, extremely similar. There are some differences. And is one better than the other? I'm not going to say that. I utilize both in my practice. I utilize both in my life, personally. And again, it's all comes down to who the person is. That's the investor. So a mutual fund, the best way to describe that I learned while working in this business, a former manager of mine, used to show this to people. So the way to describe a mutual fund is, imagine being at a pool. And at the pool, you have a lifeguard, you have the pool, and you have the kids swimming in the pool. The pool itself is the mutual fund. The kids swimming in the pool are the different investments, and those investments can include, let's say it's a growth mutual fund. That may be something like Apple, Google, Amazon, your big mega cap companies, and then some other growth stocks that are in that pool swimming. Those are the kids. You may have some bonds, you may have some fixed income stuff. It's got different allocations, but just to keep it general, the investments inside of it are the kids, and you can have 100 different kids swimming in this one pool. The lifeguard is the fund manager, and you have someone that's watching these mutual funds and doing the trading in the funds, someone that's deciding what investments are being bought and sold inside of this mutual fund. And they do so, basically, they have an objective. They have a certain allocation they need to commit to. And, if it's a tech mutual fund, then they need to keep so much in tech, But their job is to manage that fund, and if one of those little kids start drowning, it's his job to go get that kid out of the pool. So he'll go and jump in and pull that investment out, whatever it may be. If a company's doing bad, he's going to rebalance it and pull that company out and allow another kid to go in there and swim. So that's the best way to provide a description for a mutual fund. Well, what else comes with a mutual fund is when you buy and sell it, is not like buying and selling a stock. So mutual funds can get pretty complicated from an investor standpoint. And it takes a while learning how to, read these funds on, what's good, all the different variables that goes into it. They have different share classes. So you have A share mutual funds, B shares, C shares. You have R1 shares, R2 shares. There's a bunch of different share classes of mutual funds. And A shares is a very common form of it. And what an A share is, that means you're going to pay a sales charge when you buy the fund. So if I, as an advisor, have a client that we're going to invest their money into an A-share mutual fund, then depending on what the balance is or the investment amount is, let's say it's $20,000 for whatever reason, and every fund company has slightly different sales charges amounts, but generally it's about 5.75%. So that means that if I make a $20,000 mutual fund sale at 5.75%, the client, out of that $20,000, I as the advisor will receive 5.75%. So whatever that percentage of $20,000 is what I would make on that trade. So $10,000, would that be $575? So on $20,000, I'd make $1,150 on that trade. That's subtracted from the $20,000. So now the client has $1,850 or $18,500 that is that's being invested. Excuse the phone call. So that's an A share. You pay the sales charge up front, but you don't pay anything on the back end. Now, when you go to place a trade, it's not traded during the day like a stock or an ETF. It's traded after hours, and that's because you have what's called the net asset value of the fund, and that's how they get the share price of a mutual fund. And that's recalculated every day after trading hours. So whatever the performance of those investments inside the fund has done, they recalculate whatever the overall net asset value is, and that's where you would then purchase the shares of the mutual fund at whatever that price is, minus the sales charge. So if you want to redeem it, which is basically selling that fund or close it out, it works the same way. You would have to place the order during the day, and then after hours, it would recalculate, and whatever it is at the end of the day, that's what you get. So the next day, you would see that hit the books. An ETF is similar. An ETF is the same idea with the whole pool theory. You have your lifeguard, you have your pool, and you have your kids swimming in the pool as the different investments. The main difference is that an ETF is bought and sold throughout the day when trading hours are open. And you can buy and sell it just like a stock. Now, when Dave Ramsey was talking on his show about ETFs and mutual funds, this was a while ago, he said, that a high majority of ETFs were basically index funds. And there is a lot of ETFs that are index funds, but at least maybe since he made that comment, there are a lot of ETFs that aren't just index funds. In fact, you can find one that's a tech one, the ARK funds, ARK, and then whatever. Kathy Woods, right? She's the one that runs those funds. They do a lot with tech and newer innovation technology stuff. You have a lot of specified ETFs out there. There's thousands of them. Now, they're diversified as far as the investments inside of it. They're more liquid because you can get in and out of them faster than a mutual fund. They usually, maybe I'm wrong about this, but I don't think they have a holding period, where a mutual fund may have you have to hold it for 3 months or longer sometimes. And they can be a lot more tax efficient because generally inside a mutual fund, depending on which one you're in, you have what's called turnover. And turnover in a mutual fund is how much they are buying and selling the investments that are inside the fund. And when you buy and sell stocks, let's say, you have capital gains to worry about. And if they are, let's say they hold Apple in that fund, Apple has a huge gain, so they go and rebalance the fund, they sell some of those shares, they have a capital gain. Well, that capital gain is passed through to the investor in the fund. So you can receive dividends from the internal investments, and you can receive those capital gains, but those capital gains are realized, which means that you're going to have to pay taxes on. The higher the turnover, the more potential there is for you to pay capital gains tax. And if you, depending on what your income is, that could be, a serious issue. And depending what kind of account it's in. If it's in an IRA or a Roth IRA, it won't matter. But if it's in just a regular brokerage account, it could absolutely matter. ETFs, you'll find that they don't generally have that high of a turnover, but they can. And the other thing you have with mutual funds and ETFs is an expense ratio. Now, our expense ratios, are those make or breaks? Not always, but they can be. The average expense ratio, I think I saw Fidelity had something out, an article out, said the average expense ratio for a mutual fund was around 1 to 1.25%. Maybe a little more than that, depending on what fund you're in. And an ETF was like less than 0.5%. And the way the expense ratio works is you don't see that as a dollar amount. You're not paying a fee like to an advisor or as a commission. You're paying that off of your returns. So if the mutual fund returned 10% as a gross return that year, and it had a 1% expense ratio, you as the investor is going to receive 9%. And inside of that is going to be, different fees, however they allocate that. But that's basically what it costs to run the fund. And mutual funds are, on average, way higher than an ETF. You can get ETFs that are next to nothing with an expense ratio. But you can also get an ETF that has a higher expense ratio. And the higher that expense ratio, remember, the more they're taking off of the gross returns of those investments, and it kind of can eat into your gains. So unless you have a good performing investment, then it could affect you. You don't need to just turn away from investments with a high expense ratio, because there are plenty of mutual funds and ETFs that do very well that just cost more to be in. Sometimes you pay for what you get, but sometimes you don't. Sometimes it's a ripoff. And a lot of times when you see that, in my experience, you can avoid either the high expense ratio that some of the bad funds have, because you can go out and pick and choose really good funds, maybe that have a higher expense ratio, but you don't mind because the returns have been good, or ones that have low expense ratios and the returns are still good. But you will see that in a lot of products that maybe variable annuities or some IRA products that have mutual funds to choose from in that certain IRA. And I'm not explaining that in depth, and there's a lot better explanation. But there's some companies, if you go and you open up an IRA, they're going to limit the funds you have, and they have you pay fees around the certain types of funds that they have. That's a video for another day, but you'll find that they'll have higher expense ratios because the 12B1 fees that the company will make money from are higher. So they'll put those higher expense ratios with the higher 12B1 fees in there so that they're making more money off of you, but they're saying that you're lowering your overall fee that you see as a dollar amount. But overall, you do, it's either you get what you pay for, and you just need to be wary of the fund that you're looking to invest in. And ETFs can have the same problem, but again, on average, their expense ratios tend to be lower. So ETFs, as opposed to mutual funds, tend to be more tax advantaged. Again, not always, but on average. They tend to be cheaper. They're more liquid because you can buy them and sell them during the day. But the other thing is a lot of the platforms nowadays, like the Schwabs and the TD Ameritrades, and Robinhood actually started this, I believe, with the no commission trades, because payment for order flow came out. So these big platforms are able to offer, a free trading platform where you're not paying a commission anymore on buying and selling ETFs and stocks or crypto or whatever it may be. And mutual funds, while there's not always a sales charge on them, they do cost money. So if you are paying for an A-share mutual fund, which is not a bad investment, but if you just got to think, if you're buying an A-share where you're going to pay that 5.75% sales charge up front out of your balance, or you can go and invest in an ETF that kind of may do the same thing and do it for free. Well, you're starting ahead, right? If on that $20,000, after you make the mutual A-share trade, you only have $18,500 that you're trading with, or that's invested. But the ETF, you go buy basically, let's say, the same investment strategy inside of the ETF, and you're not paying the commission. Well, now you have $20,000 you're going to earn interest on. So I don't agree with Dave on on the don't invest in ETFs. I think and I don't think he means it like that. I think because I've listened to him before talk about it, and he never necessarily discouraged people from investing in the ETFs. He just thought that they were basically just tracked an index, and you can do that with a mutual fund. But and I think he's also trying to shy people away from buying and selling throughout the day, which is fine. That's perfectly fine, because he's also looking at the emotional aspect of it. But to put up on Facebook, and have it as a general don't invest in it, I don't like that. I don't think that's right, because it's basically the same thing. The other difference that there could be, though, from a diversification standpoint, is that mutual funds tend to have an allocation, but as far as Dave's model, growth and income, aggressive growth, and international, I don't think it would really matter, because your growth and your aggressive growth are going to be very high equity allocations. Growth, you may have 90% equities, 10% fixed income, which is, like I said, mutual funds will have either equities, which are stocks, or fixed income, which is like your bonds and stuff like that. They'll also throw those together. I don't think you can't have ETFs that do that. But mutual funds are big with that, so it kind of gives you a diversification across the whole playing field, not just diversification in the stock market. So that may be another advantage to the mutual fund, but I tend to like ETFs better, because I think ETFs are becoming a lot more popular, and there's better ETFs coming out. But that's just my opinion. And again, I don't just invest people's money in ETFs because I like them better. It all depends on what that person wants and what their goals are, and I'm going to go find the best investment for them that I think it is, at least, no matter what it is. ETF, mutual fund, stock, whatever. Now, some of the other investments I do disagree with, and again, he's looking at it from the fact that, if you're listening to, a lot of the people maybe listening to him are in this situation, they need the financial help. But let's look at the single stocks. He says don't invest in single stocks. Well, yes and no, as opposed to the mutual funds. Yes and no. Again, there's a place for everything. And I just want to hit on the fact that, let's say you're a basic investor, you don't know a whole lot. You do know Apple, you do know Google, you do know Amazon, Netflix, and Facebook. And what that is, that's your FANG stocks. FAANG. Facebook, Apple, Amazon, Netflix, and Google. And if you just, as a novice investor, bought into the FANG stocks, let's say 10 years ago, you would have far outperformed not only the S&P 500, like Dave Ramsey says you should do with the mutual funds, but also outperformed, I think, any mutual fund that I know of. And I was trying to find the average the other day. I believe it was around like 41%. Again, I'm not making any recommendation on this, but I'm just saying that, last year with the pandemic, everyone's kind of paying attention to the market. You saw what some of those stocks did, and I'm not saying you have to go and do a lot of research on it. Those are the biggest companies in the world. And you, as a novice investor, could have just said, ooh, Apple, I like that. I'm going to buy a share of Apple or Facebook or whatever. Like, there really didn't even have to be much research done into it, because everyone already knows about those companies, and you would have done extremely well. So I'm not going to discount investing in the single stocks, because you would have done extremely well in those FANG stocks. And again, hindsight is 20/20, right? But I mean, like I said yesterday, invest in good fundamentals, invest in the value of a company, and all of those have it. We use them every day. And if you wanted a safer bet, I mean, what is Microsoft is like $2 trillion in a market cap now. It's its own index. I don't know how big the S&P 500 is as a whole. I know it's bigger than that, but companies like Apple and Microsoft and Amazon, they're their own index almost. They're so large. They're larger than a lot of countries are. A lot of countries. So again, yeah, I'm not going to discount that. Now the Bitcoin, 100% agree with them. If you're in Bitcoin, and I know a lot of people don't like this, but if you're in Bitcoin, you're speculating. And my take on Bitcoin has changed over the last couple of years. And it really changed this year when I went to a gas station and I saw the Bitcoin ATM machines. Then I was a little more open to it. Now, I don't invest clients' money in Bitcoin. I can't offer that to people. You do that on your own. I just give my opinion on it. And whole life insurance, again, there is a place for everything. And there is actually a more common place in people's portfolios for the whole life insurance investment. And we'll also, in a video, go through that and what that entails. But there is a pretty common place in people's portfolios for whole life insurance. And Dave Ramsey is 100% wrong on that. This is actually one that people in the industry laugh at a lot of times. And there are people that agree with them that are in the industry, but this is something I think that there's a lot of industry professionals that do disagree with Dave Ramsey on this one, because the whole life insurance, especially with with some of the products they're coming out with now, there is definitely a more common place than you would think in your portfolio for it. Now, again, it's not for everyone. It is not for everyone, and it's where Dave Ramsey is correct on it is some of the ripoffs that he has run into, because you have a lot of stupid advisors that don't know how to structure a product. And they do it to make the money off the commission. That's 100% what it is. And so a lot of it is just transparency and understanding the product that the advisor is selling to the client. A lot of the advisors won't understand the product 100%. And you have to be careful on who is selling the product to you, because a financial advisor, that term is thrown around pretty loosely. Some insurance people that only do insurance may refer to themselves as financial advisors. Some that just do investments, same thing. It can be a vague term, and a lot of them may not understand a lot of the products, at least have a deep understanding of a lot of the products. They just know enough to sell it. And so structuring these policies is where clients get in trouble, and it ends up costing them money. And that's probably what Dave Ramsey is seeing, because again, a lot of the people going to him for help need the help, and they may be in a product that is screwing them over. But there is no reason to shy away from learning about them or considering them if it's right for you, because there's a lot of advantages that come with that. And again, in another video, I'll go through what that entails and what those advantages are. And then annuities, same thing. He says you don't invest in annuities, but there's a place for everything. Annuities have gotten a bad rap, I think, with the variable annuity products. There's a lot of reasons why, maybe fees, and again, going back to the people selling it. But there's a place for everything. There's a reason why these products exist. Bonds, individual bonds. Now, I haven't sold any individual bonds myself. If I did it, it would be in a mutual fund or ETF. And the reason being is just because it's just more efficient. There's a lot that goes into bonds. You have duration. You know, you have changes in interest rates. You have different kinds of bonds. You have different grades of bonds. Uh, and you can just get a mutual fund where they diversify it for you. It's just a lot easier on the advisor. I don't know how many are hands-on with it. I'm hands-on with the options trading that I do with clients. So some may be hands-on with the bonds. I'm hands-on with the stocks. I build my own models with the stocks that I do for people, you know, and so there may be some that are hands-on with bonds. I just, not me personally. And so I'm not going to comment on whether or not you should invest directly in a bond. But again, there is a time and a place for everything. And then he has micro investing. And I think when he's talking about micro investing, now these are all the don't invest ins, right? I think when he's talking about micro investing, he's talking about, like, what's that app? Acorns? Maybe where you make a purchase and it's going to take the nearest dollar amount, the change. So if you made a $1.50 purchase, it's going to take the remaining 50 cents of the $2 and invest it for you. And I don't think I agree with him on that, because you got to start somewhere. And again, he has his model, his steps you go through that, okay, you pay your debt off, then you start investing, whatever. But you got to start somewhere. I had a little interruption there, but you have to start somewhere. And now, and this goes back to the mutual funds. One of the other advantages with the mutual funds now was the dollar cost averaging. You could do, let's say, $100 a month. And you can buy what's called partial shares. So you don't have to purchase a whole share of that mutual fund. You can buy a half or a quarter or whatever percentage. You could do $1 a month if you wanted to. And that was an advantage of mutual funds, but a lot of these platforms like a Charles Schwab or TD Ameritrade now actually allows you to buy partial stock shares. So that's an advantage added to the single stocks column. But as far as the micro investing goes, that's an advantage that you can also invest in that. But I think that anything is better than nothing if you're at the place where you want to start putting money away and saving money. It just doesn't fit his model. And that's not necessarily bad, because he's basically saying that you could take that, whatever that extra money is, build up your emergency fund or pay off the debt. Those are good options, extremely good options. You could do that if you're maybe in a place where you may not have debt and you have your emergency fund, but you're still not able to invest a lot. Well, why wouldn't you invest as much as you could, right? It's all situational. So I don't have a problem with micro investing. Some people do that, and I think that actually maybe it gets people involved and it gets them excited about it. When they see that little bit of money they're putting away and it grows a little bit, maybe that's what people need to maybe learn more about the investing, because it doesn't take a lot. It doesn't take $10,000, $20,000 of investing in the stock market to learn how to invest in the stock market and the process that's behind it. It could take a couple dollars. Maybe you buy shares of whatever investment or partial shares and you see it move. You make the trade. You learn how all that works and you get more comfortable with it. And I think that being comfortable with the investing part of it is something that a lot of people run into, that they have an issue with. They're not comfortable with it. They don't understand it. They don't understand the risk. And it's kind of like going swimming for the first time. If you don't know how to swim, it takes a little bit, right? You got to learn. And you got to be comfortable in the water. But a lot of people are capable of swimming. Most people, if not all people, are capable of swimming, right? So it just takes a little push. It just takes some experience. And so I think that's what he means when he's talking about the micro investing, but I'm not 100% sure. Maybe he means micro cap investing, like micro cap would be penny stocks, and I would agree with him on that. That's like gambling. But if he means microcap and like microcap, which would be their market cap, very small penny stock companies or over the counter, or if you've seen the Wolf of Wall Street pink sheets, right? When they were talking about the hookers. Uh, but the reason why he made that reference, by the way, is because a pink sheet or a penny stock is basically the trash investments, the over the counter investments, and you can get lucky, yeah, absolutely, especially this past year. But that's kind of what he's referring to with that. If you were confused about that reference, that's why the girls he was referring to in the movie were not the better looking ones. But so if he's talking about just doing a little bits at a time, like the Acorns deal, I think I don't think that's an issue. If it's a micro cap, then yeah, I agree with him. But I just wanted to go through that because people look at this and a lot of people that follow him is like, this is what is black and white. Whatever Dave says is it is or it isn't. It is set in stone, and that's not true. And I've met with people like this, clients. And all I do is I just adjust and do what they want to do because at the end of the day, it's about you as the investor being comfortable. And it fitting into your plan as an investor because you're the one with the goals and it's your money. It is not my money as an advisor. It's not Dave's money. It's not anyone else's money but yours. And we are just here as resources to lead you down the right path and help you achieve those goals. And then not just help you achieve the goals, but help you do it in the most efficient way possible. So a lot of this stuff that seems complicated, people like myself or Dave or whoever, we have the knowledge to try and simplify it so that you understand it. But also, what I like to try to achieve is I want to teach people. I want to teach them the stuff that I've learned, and I don't know near anything like when it comes to everything that is out there to learn. So I learn every day with this. Do I know more than the basic person? Yeah, I probably, but I'm nowhere near an expert in all this. Because the experts in this are extremely knowledgeable. And my goal is just to teach people or inform them. I don't like the word teach, but inform. And just show them that they're investing your money doesn't need to be scary. It doesn't need to be complicated. It can be fun. It can be cool. And I think it's even more exciting when you know what's going on. When you have options that you own in your account and you understand the value and the purpose and the strategy behind it. And it will give you peace of mind that when you know how that stuff works, or if you own single stocks or mutual funds. So, don't just think everything's black and white. It's not. Don't just discount certain financial products because an industry professional said so. Make sure that there's basis behind it. Make sure there's reasons behind it. Because like I said in my first video, what's good for you may not be good for someone else and vice versa. But if you do decide to go with one of these financial products, make sure that it's the best one for you in that category. If it's that this whole life insurance policy is going to take care of these certain needs I need in my financial plan, make sure you're getting the best one. make that advisor be able to show you why it's the best one. And if it's not, then go find another one. So, yeah, it's kind of what I wanted to talk about today. Again, if you have any questions, feel free to ask. I'm going to put my email in the description. And if you like the video, hit like and don't forget to subscribe. Thank you.
Hi, I'm Michael.kee, Investment Advisor with EKC Financial Solutions. Our goal on this channel is to bring you valuable content as it relates to finance and investing. As a disclosure, any information discussed on this channel is not a recommendation and should be viewed for educational purposes only. Thank you.